Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what's in store for today's show. First up, we're going to be talking about a little bit of a troubling trend, and that is increasingly Americans are having trouble keeping up with their car payments. We're going to talk about some of the statistics behind that statement and some of the reasons why that might be happening. But it is a little worrying, so we're going to touch on that. We are very thankful to have our tax pro this time of year, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates, looking awfully awake and chipper considering we're in the middle of tax season. And we're going to be talking more about the 2017 tax law changes. Now that we're in the trenches, returns are getting done, we want to talk about some of the things that people are seeing, some of the things to keep an eye out for as you look at your tax return this year. So we're going to be talking to Greg about that. In our third segment, average retirement plan balances dropped in the fourth quarter of 2018. Not entirely a surprise given the market took a header, but there's actually some silver lining news behind that. We're going to talk about that in the third segment. And then finally, we have a viewer question on taking out a mortgage and checking your credit report. So we're going to handle that right at the end of the show. So let's leap right into it and talk about the first thing, which is that recently news has come out that Americans are having more and more trouble keeping up with their auto loan payments. So according to the Federal Reserve Bank of New York, 7 million people are seriously delinquent, and that's defined as 90 days or more behind on their auto loan payments. That is actually 1 million more people than in 2010, which if you recall was not too long after the end of the financial crisis. So significant number of delinquencies in the auto loan industry. Obviously worrying when we're looking at consumer credit and people having trouble keeping up with consumer credit. Let's take a look at some of the other numbers that came out with this information. 1.27 trillion is the amount of outstanding debt in auto loans. That is actually 51% more than it was in 2009. And before you wonder, well, is that adjusted for inflation? That is in fact adjusted for inflation. So 51% more in outstanding auto loan balances, even when adjusted for inflation. Next thing on the slide to touch on, auto debt currently is 9% of all consumer debt. Obviously mortgages is quite a bit bigger part of that, but it was only 6% of consumer debt in 2011. So it's becoming an increasingly larger part of consumers' debt obligations are auto loans. Another statistic, in 2018, the delinquency rate for subprime borrowers, 16.3%. So subprime borrowers would be people with lower credit records without perfect credit scores. But in 2015, that same category of subprime borrowers, the delinquency rate was only 12.4%. So people with poorer credit are having even more trouble than they were several years ago keeping up with the loans. And the final thing, I think this is an interesting statistic, the average loan length now currently stands at 69.1 months. That's just shy of 6 years. In 2010, so just 9 years ago, the average loan length was 61 months, so just over 5 years. I can remember a time when the longest car loan you could get was 5 years. Now it's not uncommon to see car loan lengths of 6 years or more. And that's merely an attempt to make the payments affordable. So there's a lot of reasons behind this, right? I mean, most people would suggest that the economy is strong, there's very low unemployment rates, people are working, and those are all true things. So why is it that people are having trouble keeping up with their car payments? Well, payments are going up. Recently, we've seen car loan interest rates climb. They came down a bit in the fourth quarter with other interest rates, but overall in 2018, the trend was toward higher rates. Of course, higher rates mean more expensive loan costs, potentially higher payments. But the other interesting statistic is the average price of a new car. I can remember a time not that long ago where seeing a BMW or Mercedes or another luxury nameplate was relatively rare. Now you see them in every driveway, and in fact, the statistics indicate that cars are becoming much more expensive. The average car price in 2018 was $37,100. Just 5 years ago, according to Edmunds.com, the average car price was only $27,500. So Americans have shown a distinct preference for larger, more luxurious, more expensive automobiles. The loan industry has responded with longer and longer terms, and now you're seeing people having trouble keeping up with those payments. So something definitely to keep an eye on, certainly in your own personal finances. All right, up next, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. We're going to talk about how tax season is unfolding so far. Stay with us. Welcome back to the Money Pros. With us now is our tax pro, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates. Have to say thank you for showing up. I know you're busy, but this is the time we all want to hear from you,
I
too,
guess,
right?
Yeah,
so,
it's good to be wanted, I guess.
All right, so we are continuing a theme we've talked about for the past few visits you've been here, which is to continue to look at the impact of the Tax Cuts and Jobs Act of 2017, because 2018 was the first year taxpayers were impacted by it, and of course that means we're in tax season for 2018. You're actually starting to see all the planning and thinking and reviewing. Now you're actually seeing people and how it's impacting their tax returns. So we want to talk to you about that. But a few other things that are in the news that I think worth touching on. One of them is we had the longest government shutdown in history. Many people were worried about how that might impact the IRS's ability to handle tax returns and generate refunds. The shutdown government's been reopened, but have you seen any impacts from that carrying over to what the IRS is able to do?
It definitely wasn't as bad as we were afraid it would be. You know, the truth of it is I think the IRS did a pretty good job in adapting to the fact they were closed down and yet still had to modify their system to accommodate all the new forms we talked about. And up until like last week, there were just a few things that we couldn't transmit electronically, a few forms that had not been approved. But overall, I think they did a pretty good job getting up to speed given the shutdown and the fact that everything was brand new. And
as of this being taped, we're pretty early in the tax season, but are you seeing any delays in refund checks being generated or anything like that?
Every day, client says, what's going to happen? And so far, we've had nobody say, hey, look, we filed a week ago or so, and we still haven't gotten our refund. So we haven't heard any complaints. But there's, like you said, the system's just getting rolling. If we're going to hear them, it'll probably be another week or so before we'll know. But so it looks like it's going pretty well.
Reason for optimism, maybe, right now. All right, well, that's good news. So the other thing in the news, we want to spend a little time talking about this because I think there's so many different dimensions to this conversation, but there's been a lot made in the media recently about people's refunds being smaller. So let's talk about that. What's going on here? Why are people's refunds, or why might they be smaller?
Well, there's so many reasons. I always say, like, a tax return's like a fingerprint, but it's a fingerprint that can change every year. So everybody's tax return could be a little bit different from one year to the next. So many things affect them: children, houses, jobs, whatever. That being said, the reality of it is, what we're seeing so far is that overall tax liabilities are down from clients, but their withholdings are down, sometimes more than the actual reduction in tax. So it's no big surprise that the refunds are lower. Back in early spring last year, the IRS and the government was saying, hey, look, you got to modify your withholdings, you got to look at your W-4s, see if your withholdings is consistent with the change in the law to make sure that, number one, you don't owe any money, and adapt to whatever that's going to be. People's paychecks were higher because withholdings were less. That was part of the plan, so people would have more money to spend on an ongoing basis. What we found, at least based on what the media says, some people wait until the end of the year to get that refund to make changes, and there was even a prediction that would have an impact on the second quarter economy because refunds are going to be off significantly from what they were. But that's not the story. The story should be, did the tax liability actually go down from 17 to 18?
So let's drill into this a little bit. I think there's a big misunderstanding among the general public. And look, we deal with taxes all day long. We don't expect everybody to be as intimately involved in them as we do. That's why we have jobs, right? So, but is it fair to say that your tax refund is not a good measure of whether you're paying more or less tax?
Absolutely 100% accurate.
And by design, the tax package that was passed, and this is not a political conversation, this is just merely accounting and math. By design, the tax package that was passed, one of the intentions was to get money into people's pockets sooner, so they adjusted withholding. So the amount you paid in 2018, assuming your income was the same, was actually less than the amount you paid in 2017. Is that also fair?
See, we see it, unless someone took a step to modify what was happening, it's almost everyone's withholding is less, sometimes significantly.
And I think it's also important to point out, we recognize that people depend on tax refunds as sort of a forced savings. But I think most financial planners, myself, anybody that's involved in personal finance would say, that's not the greatest savings account in the world because you're giving the money to the government on an interest-free basis, and you should really have control of that money. So if your refund is down, there's a school of thought that says, well, as long as your tax liability hasn't increased, that's actually an improvement to have a lower refund. So it begs the question then, because I think people, and again, this gets back to politics, and we try not to wade into that here, but it gets back to the question of, am I benefiting personally from the new tax bill? Am I better off or worse off? And if the amount of your refund is not a good metric, and you and I both agree it's not, what is the way to figure out if you're better or worse off?
So what we're doing with our clients to help them understand what actually occurred is we're getting them focused on the return. So what our viewers should do is get their 2017 return and the 2018 return and put them in front of them. Now, they look a lot different. We've covered that in our
Forms
last show.
are different.
So there's two lines that you need to look at on each. On the 2017 return, you want to look at line 56. That's your total tax before self-employment tax or premature distribution of a retirement plan penalty. And line 13 in the 2018 return. So you look at them. Is my tax more or less? Then you go down to withholding. Line 64 in 2017's return is where the withholding was, and line 16 on the 2018 return is where the withholding is. So you look and say, well, my tax went down, my withholding went down. Does that account for the difference? What we're seeing almost all the time is that's what's accounting for the difference. It's substantially. Now, there are some changes. People that had miscellaneous itemized deductions, for example, investment advisory fees, they're no longer deductible, and that might have kept them, that might have gave them a benefit before that they're not getting now. The increase in standard deduction, I believe, has offset that in a lot of ways. We could talk more about that. So we're seeing most people pay less in tax, get a smaller refund because their withholding is also less. And many times that savings in tax is pretty significant, and people need to look at it from that perspective. And clients are somewhat relieved when they realize that their refund isn't down because their tax liability went up.
It's down because they paid in less, essentially. And we've seen some research from independent institutions that follow this type of stuff that suggests that so far as many as 2/3 of individual taxpayers, not corporate taxpayers, but individual taxpayers, are in fact seeing lower tax liabilities with their return.
That's true, and it's really too bad the media is not focused on the facts of what actually is happening, and they're dramatizing it for political reasons, I think, in a lot of ways, and they're not looking at the tax return, because let's face it, not everyone even understands the mechanisms that go into derived liability.
Sure.
And they can be pretty complicated.
So we can talk about who the benefit accrues to and whether corporations benefit more than individuals and all of those things, but you got to get the math straight before you wade into that conversation.
And that's a higher level conversation anyway in terms of how the tax reform should have been apportioned.
So that's a fascinating conversation. Let's talk about some of the other changes now. There was always a certain percentage of people that itemized. They got used to keeping receipts for all the different things that they could deduct, whether it be charitable, mortgage, state taxes, all those things. There were significant changes made to what people are able to itemize. And in addition, the standard deduction has gone up. What impact so far early in the tax season are you seeing on that, on tax returns?
So what I've seen on people's faces when I tell them, look, you don't have to worry about giving me all this stuff
I don't
anymore.
need your help. This year.
And they're almost disappointed because some people, you know, they're specific, they're detailed, they want to have every expense deduction available, and they go through the process of accumulating all this information. I said, we really don't need it. I'm surprised a little bit by how many people I'm seeing that do not need to itemize anymore because of the increase to $24,000 for families, $12,000 for individuals. The individual side's helped a lot of people because before it was only $9,000 between the standard deduction, the exemption, that went up to 12 because the exemptions are gone. So they're seeing a little bit of a benefit there too. So it's really surprising. And again, some people are disappointed because now they don't have to keep track.
It's become almost a ritual for people.
But I'll tell you, right, but the real risk that scares me is that things can change, right? So it's really hard to say to someone, I forget it, but you don't have to worry about it anymore. I just had this conversation with a client yesterday, older couple, medical expenses can escalate on you. Something could happen, and now all of a sudden what might not have been deductible may be combined with everything else. So it's really hard to tell people don't worry about it anymore. What I tell them is be aware of any change in those basic categories. Tax, which is limited to 10 grand, so almost everybody's blowing that out, frankly. The interest on their house and medical expenses, in particular charitable contributions as well, is a big variable. So we can't totally ignore it, but a lot of people...
Particularly if you're close, where you
Exactly.
took the itemized deduction because it was higher, but it was pretty close. The next year, you know, a little more charitable contribution, anything could change, and all of a sudden you're back to itemizing
makes it a little
again.
difficult.
You mentioned the charitable contributions. I think you and I both share a concern that because more and more people are going to be taking a standard deduction, they're not going to be getting advantage of deducting charitable contributions. Are there any strategies available that might still allow charitable contributions to be deductible for someone?
Well, like you and I discussed, having the deduction direct from your IRA, basically all pre-tax, is going to become a more favorable strategy for people that feel philanthropic and want to continue to donate, whether it's their church or whatever the case might be, because then they're not limited. They get both deductions. They'll get the charitable deduction because it's coming right off the top of the IRA, and they're going to get the standard deduction at whatever rate it might be based on their filing status.
So
it's
great small example of tax planning is going to change just around charitable contributions, but you've got to modify your game plan because the rules of the game have changed.
Absolutely.
Good luck with tax season. We'll see
Thank
you
you.
again after it's over. Right up next, we're going to talk about declining retirement plan balances, but the silver lining behind the news. Stay with us. There's more to come. Welcome back to the Money Pros. Fidelity Investments, the retirement plan behemoth, released their data for retirement plan contributions and balances for the fourth quarter of 2018. So it's interesting data to look at because it's a great bellwether as to what's going on overall in the retirement plan industry. And there were some indications that balances had definitely dropped, primarily related to the market drop. So the average balance was $95,600 in the fourth quarter, down from a record high in the third quarter of $106,500. So there's about a 10% drop, 11% drop, depending on whether you're looking at retirement plans, IRAs, what specific type of account you were looking at. But most of that decline can be attributed to decline in the market, and a 10% drop is around where the S&P was, a little worse than that. So not totally surprising that those balances went down. But there were some encouraging signs behind the statistics. I thought I'd share them with you. The first one is 5.6%, only 5.6% of workers actually made changes to their account in the fourth quarter. So while we saw the market sliding dramatically, large cap stocks were down, small caps and mid caps were down even more substantially. International did poorly throughout the year. To only see 5% of participants monkeying with their accounts, reallocating to cash, doing things that we probably would advise them not to do, that's an encouraging sign because historically we've seen people go in, move to cash as they saw the market declining, and then they don't know when to get back into the market, and they end up losing on the rebound. Of course, we saw a significant rebound in January and so far in February of this year. So 2019's gotten off to a good start. Glad people didn't monkey with their accounts. Another thing, 99% of participants continued with their contributions. So historically, we've actually seen that when markets turn down for sustained periods of time, people shut off their contributions. They say, you know what, I'm not going to pour good money after bad. Market's going down. Why should I keep contributing? But one of the magical things about a retirement plan with payroll deduction is when you contribute as the market's declining, you're buying more and more shares. Effectively, you're buying low. And when the market does rebound, again, as it did in January and February, those deposits that you made when the market was lower give you even more return than older money in the account. So it's great to see 99% of participants with Fidelity retirement plans actually continue to contribute to their plans moving forward. Another encouraging sign in the statistics, one of the reasons average plan balances drop. Now, the main reason, to be fair, is because the market declined. The other reason average plan balances dropped is because new and younger employees enrolled. So when they open up an account for the first time, it doesn't have a whole lot of money in it. That lowers the average plan balance. But it's very encouraging to see that even in a situation where the market is declining, young people, new employees are deciding to enroll in their retirement plan because the sooner you start, the better off you're going to be, the less of your own money you're going to have to put away, and the better job the market is going to do for you. So despite the fact that we saw retirement plan balances drop, not entirely unexpected given the market, there were some encouraging signs. I thought I'd pass them along to you. All right, up next we're going to have a question on checking your credit. Stay with us. Welcome back to the Money Pros viewer question time. So let's throw the slide up and get right to it. Viewer asked me recently, I am getting ready to shop for a mortgage. Before I do, I'd like to check my credit report. What's the best way to get a copy of it? I see a lot of advertisements for free reports, but I'm not sure which ones are legitimate and which ones aren't. That's a great question, and two compliments. First of all, the idea that you want to check your credit before you shop for a loan is very smart because it means you know what you're getting into and you make sure you get the best offers given to you. We also recognize that there's a lot of offers for free credit reports, and not all of them are really the free credit report. So the website you want to go to, and this goes for anybody, is annualcreditreport.com. This was the website that the major credit reporting agencies, Equifax, Experian, and TransUnion, were required to set up by the FTC based on federal law, because it is your federal right to get a copy of your credit report every single year. And because there are 3 credit rating agencies, you can get 1 from each of them each year. So in effect, you can get 3 free per year. So go to that website. It's super easy. You can get your credit report. You can know exactly where you stand. You can make sure there are no errors on it. It's a good way to protect against identity theft. There are a whole bunch of good reasons to check your credit report, and it's easy and it really is free. So annualcreditreport.com. All right, that's it for today's Money Pros. We'll see you again next Sunday right here on the Money Pros. Thanks as always for watching. We'll see you again.